Okay, so in the last video we introduced the accounting, I was calling it the accounting process. The accounting process, or flow, or introduce another word which you'll see is the accounting, really a lot of people refer to it as the accounting cycle. It's the accounting cycle, and we'll see this probably in our textbook. People talk about the accounting cycle, but it's all the same thing, the process, the flow. It's different than the accounting equation, although it takes into consideration the accounting equation. The accounting equation, let's put versus equation. The accounting equation, which we will never violate, is that assets equals liabilities plus owner's equity. And the net income, the revenue, less expenses equals net income. That impacts owner's equity. But the process, the flow, the cycle of an original source document that gets reported, or actually recorded, into a journal. This is all review. From the journal, it gets posted to a general ledger, or a GL. From the general ledger, so it gets recorded into a journal. It gets, from the journal, it gets posted to the general ledger, and from the general ledger it gets summarized into a trial balance, which is also called TB, trial balance. And from the trial balance it's reported in our financial statements. Let me do some different colors here. So it is recorded, and then it is posted, and then it is summarized, and then it is reported into our financial statements. Okay, so that's all review of things we've talked about so far. The only thing I think I've introduced here is the idea that it's also called the accounting cycle. Now there are two tools. One is a tool and another's a rule. Let's call this one tool and one rule that we're going to rely upon as we're working through the accounting cycle. The first tool is something called a T account. T account. The reason it's called a T account is because it looks like this. There is a T. See the T? And this is a way of looking at a tool. This is the tool. A T account is a tool for understanding how a transaction impacts an account. A tool for understanding how a transaction impacts an account. So if we have a transaction that we've been talking about, we sell sneakers and we sell $10,000 worth of sneakers. So I happen to be a merchandising company. I got these sneakers from, well, hate to say it, but I got them from Indonesia, or I got them from China. That's where they were made or manufactured. I then receive them, I purchase them from Indonesia or China. I'm selling them to you. I am a merchandiser. I am MC Sports. I'm selling them to you. When I purchase those, when I sell them to you, you're going to then take those sneakers, you're going to use them, let's say. But let's say I sell you, I sell you one pair of sneakers. And let's say it's cash. I sell you sneakers for cash. And up here I say, what is the impact in the cash account? Well, you'll notice, and I could draw T accounts for each account. So cash, and I also have revenues, sales revenue of sneakers, right? Sales revenue. And I could have, for every account, we have asset accounts, liability accounts, equity accounts, revenue accounts, expense accounts. For each one of these accounts, we could draw a whole series of T accounts, because the T account is a tool for understanding how a transaction impacts an account. So In this case, I sell you sneakers. It's $100 for a pair of sneakers, and you give me cash of $100. You'll notice that there's two sides to each one of these accounts. Two sides to each one of these accounts. There's a left side and a right side. Left side, let's call them left side, right side. Left, right. You can see that, right? It's visual. A left side and a right side. For the sales account, there is a left and there's a right. For our mysterious blank account, there is a left and a right. The tool is a T account. What's the rule? Here's the rule. That for every one of these T accounts, right? Doesn't matter how many we have, for every T account, there is a debit side and a credit side. That's the rule. Debit is often abbreviated DR. Credit is often abbreviated CR. So for sales, there is a debit side, credit side. Always, see the rule? The left side is the debit. The right side is the credit. Sales account. Left side is the debit. Right side is the credit. It doesn't matter how many accounts we list here. For every account, the left side is the debit. The right side is the credit. So one tool, one rule. And the tool is we can use a T account. It's take a piece of scratch paper and just make a T. Helps us to visually understand what's going on in an account. And we put the account name up here. Account name. T account is a tool for understanding how a transaction impacts an account. The rule is every T account has a left side, which is a debit side, and a right side, which is a credit side. A debit side on the left hand, and a right side, and a credit on the right side. So you're going to have to just get familiar with this. Debits on the left, credits on the right. Debits on the left, credits on the right. I'm going to do a separate video following this one where I'm going to talk about what double entry accounting is. But for right now, I just want to introduce that brief one tool, one rule, T account, and the rules of debits and credits. See you in the next video.